What's up you guys, Sasha here. Today I want to talk about some really exciting stocks that I don't hear other people talking about. Almost every video that talks about investing in YouTube covers the US, and there are really good reasons for it. The S&P 500 is soaring, there is US tech companies that are completely dominating the world scene, and there are good reasons to go and invest in those companies. But there are 5 really exciting prospects that I wanted to mention in this video this side of the pond over in the UK that I think are just as exciting and have huge potential as well. The one really important thing to remember about UK stocks is that each time you go and buy into a UK company, whenever you buy those shares, you have to pay 0.5% stamp duty, which is really critical unless you are buying those UK stocks through eToro, who just happen to be the sponsor of this video. Now with eToro, you don't have to pay stamp duty because the platform actually covers and pays the stamp duty on your behalf, which is pretty neat. The platform doesn't have any account management fees, they don't have any trade fees, they don't have any of the old school kind of platform fees. The one fee that you will have to pay if you're based in the UK is a conversion fee. So you have to pay money to convert your pounds into dollars, which is also 0.5% whenever you're loading money onto the platform. But here is the beauty. You only have to pay that once when you're loading the money in. After that, if you're investing in UK stocks and then you go and sell those UK stocks and buy some others, you don't have to continuously pay that 0.5% every single time you go and do a buy trade. So for those who are interested in investing in UK companies, eToro is probably the best option you have for making those investments. A really brief disclaimer before we get any further. I am not a financial advisor. I can't provide financial advice to you. And if you do need financial advice, please go and seek the help of a suitably qualified professional. Now I'm going to go through these 5 companies, but I'm not going to get into great detail in any one of them because this video is already going to be way too long compared to what I want it to be. And if I went into any more depth, it would be way longer than that. So please excuse me for that. I will go into more depth on some of these stocks in upcoming videos. So make sure you subscribe if you're interested in finding out more. I'm going to start with a company that you probably haven't thought about in terms of investing. And in fact, recently some analysts have gone and downgraded the stock, which made the share price collapse by 10%. Which made me really excited because I went and bought more shares in this company because of the price being lower, and I am of course talking about Team 17. Team 17 is a video game company, but they're not new like some of the others. They've been around the block a little bit. Their first game, called Worms, was released some 25 years ago, and it continues being one of the most popular arcade games ever. But here's a really cool thing. This company's not a has-been. They aren't resting on their laurels. They are continuing to innovate, and some of the latest stuff is actually really good. They've been releasing games that are incredibly popular across different platforms from Nintendo Switch to mobile phones, and I think this is where the big money is made. It isn't in high-end gaming that only appeals to a small number of people. I think this kind of more mass-market gaming is where the real big potential is in the future. Recently they've gone and released titles like Overcooked and The Escapist, and over the last few days they've gone and acquired the Golf with Friends franchise. At a market cap of £1.14 billion, their share price might seem expensive with a PE ratio of 67, but I see a company that really gets it and is continuing to get better at what they do, and I think they're going to continue doing that for a while based on what I'm seeing. Their profit margin is 27% with net income of 31%, which is really quite good. Their growth for the last 4 accounts was 43% year on year, with H1 2020 up 28% on the same period in 2019. Their cash is up to £50 million. Next on my list is Ocado. Ocado was one of the very early food delivery businesses in the UK that's been going from strength to strength, and they're quite unusual because they're the only major one that doesn't have physical stores as well. They've been partnering with some supermarkets for some of the products, like for example with Waitrose and with Morrison's, but at the same time they're flexible and they're prepared to be working with different partners as they've shown over time. Some people say that now is the wrong time to go and invest in the food delivery business because valuations have skyrocketed over the last 12 months due to what's going on around the world. But I strongly disagree, and here is why. Food delivery business is basically something that is transforming an industry where we are as consumers very used to doing it in a particular way, but over time I can see this changing because the alternative, the food delivery business model, is better. So I can see the business changing from regular stores to delivery considerably over the next few decades, because I don't think people really want to go and spend a couple hours on a Saturday driving to the store, then going around the supermarket and putting everything into their trolley, then going and queuing at the checkout, paying, putting stuff in bags, and then driving home. I think instead those people would much prefer to spend those 2 hours in the park and have the food delivered to them. I think most people still kind of creatures of habit. They do the same thing, and I'm not saying that shops are going to disappear, but I think we're going to be switching over to this business model more and more. So I see the industry growing. And I see that a company that doesn't have physical assets, it doesn't have stores, it can optimize its delivery network much better than supermarkets because it doesn't have supermarkets to serve. So it can be much more smart with how it structures its warehouses, with how it structures the way that food is managed and the way that it is sourced and the way that it is supplied. I think they have a massive, unique competitive advantage over the supermarkets in that, and that's why I'm particularly excited about where they might go. Their market cap is £20.8 billion, which is high for a company that's been loss-making for quite some time, and they haven't been shown to actually be profit-making except for the occasional Q4 where food goes rampant in terms of spent by the consumers. But at the same time, the supermarkets are posting profits. So most people will be saying, well, hang on, I don't want to be investing in something that is loss-making within a broader industry that is actually not. But I have a slightly different view. The company posted a gross profit of £597 million in 2019 and a mammoth gross profit of £362 million for H2 2020. Although basic administrative expenses still bring the number to below zero on the net basis. However, this company is about to post their latest results. They're coming out on the 9th of February 2021. And the reason I'm particularly excited about is I think this market is going to be continuing growing, and those results will show that their revenues are continuing to grow and their customer base is growing as well. And I think the moment people see that, and the moment that trend continues for the next set of results to release after that and the one after that, I think that this can go a lot further than it already has gone. So that's why I'm excited by Ocado. Now, ASHTEAD Group is a company you might not have heard of by name, but they're kind of a big deal, and they are so big that they are in the FTSE 100. They operate about 1,200 different stores across the UK, US, and Canada under their Sunbelt Rentals brand. And what they do is they rent industrial equipment, predominantly to the construction industry, but also to other types of industries around those countries. Their business is incredibly robust, and I think that the industry that they're in is going to be growing massively over the coming years and potentially decades. If you look in history, at any point in time when there was a massive downturn in economy and general people's livelihoods and people's situations, the time after that was a massive rebuild scenario. Governments invest a huge amount of money to go and build up infrastructure, to create jobs, to give jobs to people building the jobs, and all of that kind of stuff. And I think the exact same thing is likely to be happening during the 2020s. Now, as the construction industry, I think, is going to be going through a massive boom to generate all of these things, as there's going to be huge amounts of money poured into infrastructure, I can see companies like this that are literally selling the picks in pretty much to the people who are doing all of that work, being the sort of company that I'm interested in investing in. In 2020, they had £5 billion worth of revenue, which generated a net income of £740 million. That is a 15% margin, which is incredibly solid for this type of business. The company's revenue has grown by about 10% per year over the last few years, and although their long-term debt number has grown considerably, it is now over 100% off their turnover. The PE ratio of 17.5 for a market cap of £17.2 billion is something that I like a lot. Next on my list is Games Workshop of Warhammer fame. Now, this one might seem really random to some people, but this is a FTSE 250 company, and they have some incredible numbers behind them. Their business is based on miniature war games that they're very well known for, but they've managed to expand and build on top of that to everything from video games through to card games through to full-blown movies. The latest 6-month results show an operating profit of £92 million on revenues of £187 million. That is one insane margin for a company whose revenues are continuing to grow. Their share price seems to agree with my estimations of where this company can go as they continue delving into these new markets and growing their presence in those markets. Their share price went up by 50% over the last year and is about 20 times what it was just 5 years ago. Their PE ratio is on the high end at 48 for a market cap of £3.4 billion, but for a business that is shown to be super resilient over a period of decades and has a huge following of super dedicated fans, together with these types of numbers, I just don't think that's a big downside. Next on my list is Royal Mail, and some people might be wondering, really, Sasha, you're excited about Royal Mail? And yes, I am. I am extremely excited by them, and there are not one but two big reasons why I'm so excited. First, the general world of business in the UK is changing fast, and some people will say, well, this is temporary, this is to do with the situation we find ourselves in, the lockdowns and all of that stuff, but I disagree. I think this has been just an impetus that is pushing people to go and adapt business models which would otherwise have taken longer to actually come through, but they would have come through anyway. People are working remotely more than ever. New startups are being created at an increasing rate, and the world of business is becoming much more diversified with many more small players working together. These remote businesses need to go and communicate, need to go and exchange products, need to go and be able to send stuff to each other. And I understand that a lot of this is being done online, and there are loads of different courier companies and delivery companies, but Royal Mail is by far the best one out of them in terms of their reach, in terms of their accessibility. And I think if they continue developing that side of their business, they can continue to dominate this market for years to come. But also I think Royal Mail has a massive opportunity with serving consumers. As more and more businesses are going online, as more and more people are buying stuff remotely, this is only going to grow. And I understand that today a lot of the companies that do this type of work, starting from Amazon and ending with pretty much anyone else out there, the vast majority of them do not actually use Royal Mail in order to do the deliveries, because there's so many different courier options and there's so many different companies who do the same thing. But Royal Mail has a number of unique advantages that those other companies do not, as they compete with them in the future for a greater share of the market. This is what I really like. They are a brand that is far better and far beyond anyone else in terms of recognition, in terms of knowledge, and in terms of accessibility. They also have a unique structure in place where they have a unique relationship with the post office, where they have access to their network and they are much better integrated into it because of history, and into their sorting branches and a bunch of other stuff like it. So I think that that is one really important factor. A second really important factor is their delivery network is broader, wider, and more far-reaching than any of the other ones. And they have certain restrictions in terms of how to work, but also some benefits in terms of they provide guarantees around their deliveries that the other providers do not have. I think some of this uniqueness puts them into a unique position where they are sort of seen as the big behemoth, the one company that everyone knows, the first one that people would name if they were talking about UK postage, yet they are actually comparatively small in this big game. And as a result, I think they have huge opportunity for growth in an industry that is itself growing. Their share price has skyrocketed during the pandemic, and some might think that now is a bad time to buy, but I am not interested in timing the market. We have a company with a market cap of £4 billion that has a PE ratio of less than 14. And this company happens to operate in a growing market, and they themselves have huge capacity for growth that I outlined above. That is all of my boxes ticked. Now that's all I have for today. If you enjoyed this video, please go and smash the like button for the YouTube algorithm. Thank you very much for watching. I really appreciate it, and I'll see you guys as always in the next video.